Hi, and welcome to Mastering Mortgage Basics, a beginner's guide to home loans. I'm so excited that you've decided to join this journey and take the first step toward understanding mortgages and securing your dream home. Whether you're a first-time homebuyer or simply looking to sharpen your financial knowledge, you're in the right place. This course is designed to give you all of the essential tools and knowledge you need to confidently navigate the home loan process. Here's what we'll cover: the basics of how mortgages work, how to prepare your credit and finances to qualify for the best loan, the step-by-step mortgage process from pre-approval to closing, how to choose the right mortgage for your situation, practical strategies to overcome challenges like unexpected expenses or even a loan denial. By the end of this course, you'll have the confidence and skills to make informed decisions that will save you time, money, and stress on your path to home ownership. This is a practical course, which means you'll get the most out of it by actively participating. So be sure to download the course templates. These include checklists, guides, and tools designed to simplify the process. You'll find them in the resources section of this course. Engage fully. Take notes. Pause to reflect and apply what you're learning to your personal situation. The more you participate, the more value you'll get from this course. Now let's get started. Go ahead and continue to the next lecture where we're going to get started on the basics of mortgages and how they work.
Mastering Mortgage Basics, a beginner's guide to home loans. Learn the essentials of home loans, mortgages, and loan qualification to secure your dream home with confidence. I'm your instructor, Joe Correa, and I want to welcome you to this course. I'm very excited to have you here. Hi, and welcome to Section 1 of Mastering Mortgage Basics. In this first lesson, we're going to cover the foundation of everything, the mortgage. What exactly is a mortgage? Why is it important? And how does it work? Let's get started. The foundation of mortgages. Mortgage is a loan specifically designed to help people buy a home or property. Since most people can't afford to pay for a house upfront with cash, a mortgage allows you to borrow money from a lender, such as a bank or a financial institution, to cover the cost. Think of it like this. The lender agrees to give you the money, but in return, you promise to pay it back over time with interest. The house itself acts as collateral, meaning the lender can take ownership of the property if you fail to make payments. Mortgages typically span 15 to 30 years, depending on the loan terms you decide to choose. But here's a key takeaway. Understanding how mortgages work will empower you to make informed decisions and save thousands over the life of the loan. Now that you know what a mortgage is, let's talk about the key players involved in the actual mortgage process. When it comes to getting a mortgage, there are a few key players you'll interact with along the way. Let's break it down. First of all, there's borrowers, which is you, the person who needs the loan. You'll need to demonstrate your financial capability to qualify for the loan. Then there's the lenders. These are the banks, credit unions, or mortgage companies that provide the funds. They'll assess your credit worthiness to determine whether you qualify or not. Then there's loan processors. These professionals handle the paperwork, ensuring all your documentation is in order before sending it to underwriting. Then there's underwriters. The underwriter's job is to assess the risk of lending to you. They'll evaluate your credit, income, and financial history to decide if you're approved or not. When I got my first loan, I was amazed at how many people were involved. I thought I was just dealing with the bank, but it's really a team effort behind the scenes. Now that you know the key players, let's explore the different types of mortgages available to you. Types of mortgage loans. Not all mortgages are created equal. There are different types of home loans, each with its own unique benefits and challenges. Let's look at the most common options. First of all, there are fixed rate mortgages. With a fixed rate mortgage, your interest rate stays the same for the life of the loan. This means your monthly payments are predictable, which makes budgeting much easier. It's a great option if you plan to stay in your home for a long time, and I highly suggest you use fixed mortgages, especially when you're just starting out and you're not familiar with adjustable rate mortgages. Now, when it comes to adjustable rate mortgages or ARMs, on the other hand, they have an interest rate that can change over time. Sometimes they'll be fixed for 3 years, for 5 years, for 7 years, 10 years. While they often start with a lower rate, it can increase after a set period. This type of mortgage is ideal if you only plan to stay in the home for a few years, and then you're sure that you're going to be able to sell it after that point. Government-backed loans. FHA, VA, and USDA loans are backed by the government and designed to make home ownership much more accessible to more people. For example, FHA loans are great for first-time home buyers with low credit scores, while VA loans offer fantastic benefits for veterans and active duty service members. Now let's talk about conventional loans. These aren't backed by the government and often require higher credit scores, but just slightly higher credit scores, by the way, and slightly higher, larger down payments, okay? But they can offer competitive rates for qualified buyers, and usually the mortgage insurance is slightly lower. Now, here's something surprising. The 30-year fixed rate mortgage wasn't always the standard. It became popular only after the Great Depression to help people buy homes during tough financial times. Now, which mortgage type sounds like it might work for you? Keep this in mind as we continue through the course. Choosing the right loan is one of the most important decisions you'll actually make. Now that we've covered the basics of mortgages, you're ready to move forward with understanding the home loan process in more detail. Let's continue. The home loan process. Welcome back. In this section, we'll break down the mortgage process step by step. While it may seem complicated, I'm here to show you that it's actually manageable when you understand the journey from start to finish. So let's begin. Here are the 5 main steps to getting a mortgage. Number 1, the pre-approval. Pre-approval is your first step. It's when a lender reviews your finances, credit score, income, and debt to give you an estimate of how much you can actually borrow. This is definitely crucial because it shows sellers you're serious and you are ready to buy. Number 2, house hunting. This is the fun part. Once pre-approved, you can start looking for your dream home. Keep your budget in mind, and remember, just because you're pre-approved for a certain amount, it doesn't mean you have to spend it all, okay? So if you're approved for $300,000, you can search for homes under $300,000. So if you find a home that's $250,000, even better, because then that way your housing payment will be much lower. Number 3, the loan application. After you find the perfect home, you'll officially apply for the loan. This involves submitting all the necessary documentation and paperwork, including pay stubs, tax returns, and bank statements, which are usually the last 2 pay stubs, and then tax returns if you're self-employed or if you have rental income. Besides that, you usually need to provide 1 or 2 years of your W-2s. Number 4, underwriting. Underwriting is where the magic happens. The lender's underwriter reviews your financial profile and the home's appraisal to determine if the loan is approved, denied, or suspended, or if it's incomplete and additional documentation is required. 5, closing. Finally, it's closing time. You'll sign a stack of documents, pay any remaining fees, and officially become a homeowner. Congratulations. Now, I want you to think of the mortgage process like running a race. It's important to stay steady, be prepared, and celebrate when you cross the finish line. Now that you know the basic steps, let's discuss the difference between pre-approval and pre-qualification so that you can understand why one is better than the other. You've probably heard the terms pre-approval and pre-qualification used interchangeably, but they're not the same. Let's clear up the confusion. First of all, pre-qualification is basically an informal process. You provide basic financial information and the lender gives you a rough estimate of how much you might qualify for. However, it doesn't carry much weight with sellers since your financial details aren't verified. Now, when it comes to the pre-approval, on the other hand, this is much more detailed. The lender reviews your credit score, income, and assets, and then gives you a formal letter stating how much they're willing to lend you. Sellers love this because it shows you're serious and financially ready. Here's a quick story. One of my clients skipped pre-approval and lost out on their dream home because another buyer had a pre-approval letter. Don't let that happen to you. Now that you know why pre-approval is so important, let's talk about what you need to gather to get started. Applying for a mortgage can feel like a paperwork marathon, but don't worry, I'm here to help you get organized. Let's go over the key documents you'll need. Proof of income. You'll need your last 2 pay stubs, your 2 most recent W-2s for the most recent 2 years, or tax returns to prove your income. If you're self-employed, this might include additional documentation like a profit and loss statement or a 1099. Credit history. Lenders will check your credit score and history to assess your reliability as a borrower. If you have errors on your credit report, fix them before applying. Bank statements. You'll need to show your recent bank statements to prove you have enough savings for the down payment and closing costs, and sometimes even for reserves. Employment verification. Your lender may contact your employer to confirm your job status and income. Now here's a pro tip. Start gathering these documents early. The more prepared you are, the smoother the process will go with the lender or bank. With all your documents in order, now you're ready to navigate the rest of the mortgage process like a pro. Let's move on. Credit and financial preparation. Credit and financial preparation, the building blocks of getting approved for a mortgage. First, let's talk about your credit score and why it's so important in the mortgage process. Your credit score is a 3-digit number that reflects how well you've managed debt in the past. It's one of the first things lenders look at because it helps them gauge how risky it is to lend you money. Typically, scores range from 300 to 850, and here's how they're categorized. When you have a credit score between 300 and 579, it's a poor credit score, okay? Which means you'll probably not get many approvals from many different lenders. You might be required to come in with a higher down payment, and it's not the ideal situation when you're initially purchasing your first home. If you have a 580 to 669, this is considered a fair credit score or an okay credit score. If you have 670 to 739, this is considered a good credit score, and you'll probably get approved for a home loan, and the terms will be favorable. If you have 740 to 799, you have very good credit score, and that credit score will allow you to have a much better interest rate. And then if you have 800 plus, that means you have excellent credit and you'll get the very best interest rates and terms with most lenders. But now you have to take into account that there are 3 credit scores that will actually come up, and the lender will use the middle one, not the average of the 3, whatever the middle one is. So if you have 700, 750, and 800, they will use the 750. Lenders typically require a minimum credit score of 620 for most conventional loans, but for FHA, it might be just 580, which is very common. But higher credit scores can get you better interest rates and save you thousands over the life of the loan when it comes to the interest you'll accumulate over the life of the mortgage loan. Did you know that even a small improvement in your credit score, like going from 670 to 740, could save you tens of thousands of dollars in interest? If your score isn't where you want it to be, don't worry. Start by paying your bills on time. Paying down credit card balances and disputing any errors on your credit report make a huge difference. So get started with that right away because every point helps. Now that you understand credit scores, let's move on to another key factor lenders evaluate: your debt to income ratio. When it comes to getting a mortgage, your debt to income ratio, or DTI, is just as important as your credit score. Let's break it down. DTI measures the percentage of your monthly income that goes toward paying debts. Here's how you can calculate it. So DTI equals your total monthly debt payments divided by your gross monthly income times 100. So when we say gross monthly income, that means without any deductions, okay? For example, if you earn $5,000 per month and your total debt payments are $1,500, then we would divide 1,500 by 5,000 and your DTI would be 30%. Lenders generally prefer a DTI of 43% or lower for most loan programs, although lower is always better. The ratio tells lenders how much room you have in your budget to handle a mortgage payment. And the lower the ratio is, the safer it is for them to lend, because then you become a lower risk. Think of DTI like this. If your monthly income is a pie, the less of it that's eaten up by debt, the more you have left for a mortgage. And that's exactly what lenders want to see. To improve your DTI, focus on paying down in high interest debt like credit cards or consolidating loans to reduce monthly payments. This not only boosts your financial profile, but can also increase the amount of money you're approved for. With your DTI in check, the next step is saving for a down payment. Let's explore how much you'll need and strategies to get there. Saving for a down payment is one of the biggest hurdles for home buyers, but with a clear plan, it's absolutely achievable. Let's talk about how much you need and where to find help if you're short on cash. The amount you'll need depends on the type of loan. Conventional loans typically require 5 to 20% of the home's purchase price. FHA loans require as little as 3.5%, and then there are other programs that allow for down payment assistance, which might even reduce that amount even more. VA and USDA loans offer zero down payment options for those who qualify. So for a $300,000 home, you might need anywhere from $10,500 to $60,000 for a down payment, depending on your loan type. But most people qualify for the minimum 3.5% with FHA, which is a huge hurdle that can be overcome by simply having that 3.5% down payment, or by having the very minimum of a 5% to be able to do a conventional loan. Did you know that putting down 20% not only avoids private mortgage insurance or PMI, but can also lower your monthly payments significantly? It's worth aiming for if you can. If saving feels overwhelming, here are a few strategies. Set up a dedicated savings account and automate deposits. That's a huge bonus and such a great idea, okay? So that's something that you can do right away, and even small deposits over time will add up quickly. Next, cut back on non-essential spending. Next, look into down payment assistance programs. Many states offer grants or low interest loans to help first-time home buyers. With your credit, DTI, and down payment in good shape, you're well on your way to securing a mortgage. Next, we're going to go ahead and start choosing the right mortgage for your financial situation in section number 4. Choosing the right mortgage. Welcome to section number 4. Now that you've prepared your finances, it's time to choose the right mortgage for your needs. With so many options available, this decision can feel overwhelming, but don't worry. By the end of this lesson, you'll know exactly what to look for. When comparing mortgage options, there are 3 main factors to consider. Number 1, mortgage interest rates. The interest rate determines how much you'll pay to borrow money. A lower interest rate means smaller monthly payments and significant savings over time. Rates can vary depending on your credit score, loan type, and market conditions. Number 2, loan terms. Loan terms usually range from 15 to 30 years. A 15-year loan has higher monthly payments but saves you money in interest. A 30-year loan, on the other hand, offers lower monthly payments but costs much more in the long run. Choose a term that fits your budget and financial goals. Number 3, closing costs. Don't forget about closing costs. These include fees for appraisals, inspections, and lender services. They typically range from 2 to 5% of the loan amount. Some lenders offer no closing cost options, but these may come with higher interest rates. It's important that you understand that as well. Did you know that over the life of a 30-year loan, a difference of just 0.5% in interest rate could save you tens of thousands of dollars? That's why it's so important to shop around. Now that you know the key factors, let's get started on how to compare different loan options effectively. Not all loans are created equal, and finding the right one requires careful comparison. Let's walk through the process. Here's how to compare loan options step by step. Number 1, I want you to gather loan estimates. Request loan estimates from at least 3 lenders. These documents outline the interest rate, monthly payment, and closing costs for each loan option. Number 2, look beyond the interest rate. While the interest rate is important, also consider factors like the annual percentage rate or APR, which includes fees and any prepayment penalties that could cost you later on. Number 3, use online tools. Mortgage calculators can help you see how changes in interest rates, loan terms, or down payments will affect your monthly payment now and in the future. Number 4, ask questions. Don't hesitate to ask lenders for clarification. What happens if interest rates rise? Are there any hidden fees? The more you know, the better prepared you'll be. Now, let me give you a pro tip. Consider working with a mortgage broker. They can shop around for you, saving you time and potentially finding deals you wouldn't get on your own. I own a mortgage company, and as a mortgage broker or mortgage brokerage business, this is what I do by comparing interest rates and getting borrowers the best terms. And in that way, I usually beat banks when it comes to interest rate and fees, but I also get the best loan terms for the borrowers as well. Now that you know how to compare loans, let's explore the age-old question. Should you choose a fixed rate or an adjustable rate mortgage? One of the biggest decisions you'll make is choosing between a fixed rate and an adjustable rate mortgage, or ARM. Each has its pros and cons, and the right choice depends on your situation. Let's break it down. Fixed rate mortgages. With a fixed rate mortgage, your interest rate stays the same for the entire loan term. This means predictable monthly payments, which makes budgeting much, much easier. Fixed rates are ideal if you plan to stay in your home for a long time or if you want stability in your finances. When it comes to adjustable rate mortgages or ARMs, they offer an initial interest rate, but that rate can change after a set period. So that can be usually 3 years, 5 years, 7 years, 10 years. Sometimes those amount of years can change as well. And the way they change can also affect the way the loan is paid over the life of the loan. This type of mortgage is great if you plan to move or refinance before the rate adjusts. However, ARMs come with some risk because your payment could increase if interest rates rise. And this can be an issue for a lot of people. Be very, very careful when it comes to adjustable rate mortgages. Make sure you understand what you're getting into and that your finances can allow you to cover any increases in interest rates if that happens to you. Let's say you're buying a $300,000 home with a fixed rate mortgage of 5%. Your payment stays steady, but with an ARM, you might start at 3% for the first 5 years, saving money up front. Just be prepared for the possibility of higher payments later on. Now, you want to ask yourself 2 key questions. Number 1, how long do you plan to stay in the home? And number 2, are you comfortable with potential rate changes? Now, the answer to these questions will guide you to the right choice. Now that you've explored the different loan types, you're well on your way to making an informed decision. In the next section, we'll tackle what to expect during the closing process. Let's keep going. The closing process. You've made it this far. Congratulations. Closing on a home is the final step in the mortgage process, and it's an exciting moment when you officially become a homeowner. But what exactly happens during the closing? Let's walk through it together. Closing is the process where you sign the final paperwork to transfer ownership of the home. Here's what you can expect. Number 1, you're going to review key documents. You'll review and sign several important documents, including the loan estimate and the closing disclosure to confirm all the loan details, closing costs, and the interest rates and monthly payments you'll have. The promissory note, your promise to repay the loan. The deed of trust or mortgage, which secures the loan with the property. Number 2, paying closing costs. These typically include fees for appraisals, title insurance, lender services, credit reports, and so many other things. Closing costs usually range from 2 to 5% of the loan amount, but that depends also on some of the title fees that you might have, what the lender charges to do the loan, and many other things. So you have to make sure that you ask for a good range before you even sign any of the paperwork or exactly what will be that amount. Make sure to bring a cashier's check or arrange a wire transfer for these costs. I suggest a wire transfer because it tends to be much easier, faster, and you know the money's already there at the title with the title company. There are no surprises or no changes after that. Number 3, receive the keys. Once all documents are signed, funds are transferred, and everything is finalized, you'll receive the keys to your new home. Congratulations. Pro tip: before closing day, review the closing disclosure carefully and compare it to your loan estimate. If anything looks off, don't hesitate to ask questions. There's nothing wrong with that. Now that you know what happens during the closing, let's talk about avoiding common pitfalls that can derail the process. While closing is a straightforward process, there are a few potential roadblocks that can arise. Let's go over some of the most common pitfalls and how to avoid them. Number 1, last-minute credit changes. Avoid taking on new debt or opening new credit accounts before closing. I can't express how important this is. Please make sure to not apply for any new debts or credit. May it be car payments, credit cards, or anything else. Even a small change in your financial profile could jeopardize your loan approval. And it has happened to me in the past when I've had borrowers where they've had their credit pulled and then they're not able to get the loan because of that. So make sure you don't fall for that trap and you don't get surprised with that situation. Number 2, missing documentation. Make sure you've submitted all requested documents to your lender well in advance. Missing paperwork can delay or even cancel your closing. Number 3, underestimating closing costs. Double check your closing disclosure to ensure you have enough funds to cover all the costs. If you're unsure about fees, ask your lender or closing agent for any clarification that is needed. Number 4, skipping the final walkthrough. Always do a final walkthrough of the property before closing to ensure it's in the agreed upon condition. If something's not right, address it immediately. Now, I want to tell you a quick story. I once had a client who bought new furniture on credit right before the closing, and the lender pulled the credit report again, causing their DTI to rise and delaying the process. Don't let this happen to you. Now that you know what to avoid, let's discuss what happens after closing and how to manage your mortgage effectively. What to do after closing. Closing on your mortgage is a major milestone, but the journey doesn't end there. Let's talk about what you need to do after closing to stay on top of your mortgage and ownership responsibilities. Number 1, set up your monthly payments. Your first mortgage payment will typically be due 1 to 2 months after closing. Set up automatic payments to ensure you never miss a due date. This is a great tip. Making sure you have automatic payments allows you to always pay consistently so that your credit scores remain nice and high. Number 2, save your documents. Keep copies of all your closing documents in a safe place. You'll need them for taxes, refinancing, or future transactions that you may decide to have when it comes to purchasing other homes. Number 3, budget for ongoing expenses. Owning a home comes with additional costs. That's just a reality, like property taxes, homeowners insurance, and maintenance. Make sure to budget accordingly to avoid any surprises later on. Number 4, monitor your mortgage statement. Check your monthly statements to ensure payments are applied correctly and that there are no errors. Here's another pro tip. Consider making extra payments toward your principal whenever possible. Even small additional payments can significantly reduce the life of your loan and save you thousands in interest. Congratulations! You've made it through the entire closing process and beyond. In the next section, we'll address common challenges and how to overcome them so you're always prepared for what's ahead. Why loans get denied. Being denied a mortgage can be disheartening, but it's not the end of the world or the end of the world. Many people face this challenge and bounce back stronger. Let's talk about why loans get denied and how you can turn things around. Number 1, low credit score. If your credit score isn't high enough, focus on improving it by basically paying your bills on time, reducing credit card balances, disputing any errors on your credit report. This process takes time, but every improvement makes a big, big difference, okay? Number two, high debt to income ratio or DTI. If your DTI is too high, work on reducing your debt or increasing your income. This might mean paying down credit cards, consolidating loans, or picking up a side hustle temporarily, even if it's a part-time job. Number three, insufficient income or job history. If your income is unstable or too low, consider waiting to apply until you've been on the job longer or have a steady income source. This will usually mean that you'll need to be on your job for at least a year or 2 years, depending on the loan program for which you're applying for. Number four, insufficient down payment. If your down payment is too small, look into down payment assistance programs or save for a bit longer. Remember, a denial isn't permanent. Many people get approved on their second or third try after taking steps to improve their financial situation. Now that we've covered loan denial, let's discuss how to handle unexpected expenses that can arise after you've bought your home. How to handle homeownership expenses. Homeownership comes with its share of surprises, from sudden repairs to higher than expected utility bills. The key is being prepared and having a plan in place. Let's explore how to manage these challenges. Number one, repairs and maintenance. Owning a home means being responsible for maintenance and repairs. It's just a reality of life. From a leaky roof to a broken water heater, these costs can add up quickly. To prepare, set up an emergency fund specifically for home repairs. Budget 1 to 3% of your home's value annually for maintenance. That means if you have a home that's worth $100,000, we would budget $1,000 to $3,000 per year to be able to cover any surprises and repairs that need to be made. Number two, property taxes and insurance. Sometimes property taxes or insurance premiums can increase unexpectedly. Monitor your escrow account and be ready for adjustments in your monthly mortgage payment. Number three, utilities and HOA fees. Utilities and HOA fees can fluctuate, especially during extreme weather or if your community raises fees. Track your usage and shop around for better utility rates if possible. Sometimes in different areas, there's competition when it comes to utility companies. See which one offers the best payments and then go with them. Here's a quick story. One homeowner I worked with faced a $5,000 plumbing repair just months after moving in. Thankfully, they had an emergency fund in place, which made the situation much less stressful. Planning ahead really does pay off. And if you can get a property inspection at the beginning of the purchase process, I'd say this is a really good idea. Even though you might pay, anywhere from $150 to $300 or $400 initially, it is definitely worthwhile because then you can negotiate some of these repairs or even get a credit from the seller. With a plan for unexpected expenses, let's move on to another important topic, refinancing your mortgage. Refinancing, a powerful tool for saving money and achieving financial goals. Refinancing can be a powerful tool for saving money and achieving your financial goals, but it's not always the right choice for everyone. Let's break down when and why you might consider refinancing. Refinancing means replacing your current mortgage with a new one, often with better terms. Here's when it makes sense. Number one, to lower your interest rate. If interest rates have dropped since you first got your mortgage, refinancing can lower your monthly payment and save you thousands in interest over the life of your mortgage loan. Number two, to shorten your loan term. Switching from a 30-year loan to a 15-year loan can help you pay off your mortgage much faster and save you on interest, even though your monthly payments will be higher. I did this and it really helped out when it comes to the interest I pay over the month, over the life of the loan, and it's going to save me at the end of paying off that mortgage thousands of dollars in interest I would have given just away to the lender. Number three, to tap into home equity. A cash out refinance allows you to borrow against your home's equity for major expenses like home improvements or paying off high interest debt. Just be cautious. It increases the amount you owe on your home later on if you take out more debt. Number four, to eliminate PMI or private mortgage insurance. If you originally put down less than 20% and have been paying private mortgage insurance like a lot of people do, or PMI, refinancing once you've built up equity that covers at least the 20%, you can eliminate this extra cost and save that amount. Frequently asked questions. Pro tip: before refinancing, calculate the break-even point. How long will it take you to recoup the closing costs with your new monthly savings? If you don't plan to stay in the home long enough to break it even, refinancing might not even be worth it. So let's say you refinance and you're going to recover whatever costs you had, even though your monthly payment went down. But let's say you had $15,000 in expert tips to set up for success. First-time homebuyers face a lot of challenges, but with the right strategies, you can avoid common mistakes and make smarter decisions. Here are my top expert tips to set you up for success. First of all, don't max out your budget. Just because you're approved for a certain amount, it doesn't mean you should spend it all. Leave room in your budget for unexpected expenses, future repairs, or lifestyle changes. Second, shop around for lenders. Don't settle for the first lender that offers you a loan. Compare rates, terms, and fees from at least 3 lenders to ensure you're getting the best deal, or work with a mortgage broker that will do that for you and save you time and money in the long run. Third, plan for closing costs. Many first-time buyers overlook closing costs, which can be significant. Budget for 2 to 5% of the home's purchase price and make sure you have those funds ready. Fourth, don't skip the home inspection. Always get a professional home inspection, even if it's optional. It can uncover costly issues like structural damage or plumbing problems that you might otherwise miss. Fifth, stay calm during the process. Buying a home is exciting, but you can also get stressed out. Stay organized, respond to lender requests promptly, and remember that delays are sometimes part of the process and it can be very normal to have delays. Okay, so be patient and do not get stressed over those situations. I want to give you a fun fact. Over 60% of first-time homebuyers regret rushing their purchase. So I want you to take your time, do your research, and trust the process. With these expert tips, you're now fully equipped to tackle the mortgage journey. Let's wrap up the course with some final thoughts and resources to help you take it to the next step. Total cost that you had to cover between paying off credit cards and any other debt that you had when you refinanced. And in the end, that those $15,000 that you're going to save won't be recovered in a year. For example, when you're planning to sell in a year, might not be worth it. But if it's longer than that, it definitely would be a huge benefit. With these strategies, you're now equipped to handle challenges and make the most of your homeownership journey. Next up, we'll cover some of the most frequently asked questions and expert tips to wrap up the course. Congratulations on making it to the final section of this course. To wrap things up, I'll answer some of the most frequently asked questions about mortgages. These questions often come up during the process, so let's make sure you leave with all the answers you need. Here are the top FAQs or frequently asked questions I get from homeowners. Number 1, how much house can I afford? A good rule of thumb is to keep your monthly housing expenses, mortgage, taxes, and insurance at or below 28% of your gross monthly income. Tools like online mortgage calculators can help you estimate what you can comfortably afford. But in the end, the most important thing is that you can afford that payment, not just what you qualify for, okay? Number 2, what's the difference between pre-approval and pre-qualification? We covered this earlier, but to recap, pre-qualification is a rough estimate of how much you might borrow, while pre-approval is a more formal process that verifies your financial details. Sellers take pre-approvals much more seriously, okay? So that's the document you want to have. Number 3, can I pay off my mortgage early? Yes, in most cases, check with your loan terms for prepayment penalties, but most FHA, VA, and conventional loans don't have prepayment penalties. Making extra payments towards your principal can save you thousands in interest over the life of your loan. Number 4, what if I have bad credit? If your credit score is low, focus on improving it before applying for a mortgage. Alternatively, explore government-backed loans like FHA or USDA loans, which have more lenient credit requirements. So if your credit is low, you might still get approved with an FHA or USDA loan. Number 5, should I buy points to lower my interest rate? Now, this is an important topic. Buying points means paying upfront to reduce your interest rate. So sometimes you'll pay $1,000 or $2,000 to drop your interest rate by maybe 0.25. But this can be a smart move if you plan to stay in your home for the long term. But it's not always worth it if it's just for the short term and you're going to own it for just 1, 2, or maybe even 3 years. I want you to always do the math to see if it makes sense for you. Remember, no question is too small. Always ask your lender, realtor, or financial advisor if you're unsure about something. This is your investment and clarity is key. And then if you're working with me as your mortgage broker, there's no problem. You can call me, email me, text me, ask me. I want to help you out. I want to make sure you get the right mortgage. Now that we've addressed common questions, let's move on to some expert tips to help you navigate your mortgage journey like a pro. Congratulations! You've completed Mastering Mortgage Basics. You've learned so much about the mortgage process, from understanding the basics to choosing the right loan and navigating closing. Let's review the key takeaways and resources available to you moving forward. Number 1, key takeaways. You now understand the key components of mortgages, including credit preparation, DTI, loan types, and the step-by-step process of buying a home. You've learned how to avoid common pitfalls, manage unexpected challenges, and confidently choose the best loan for your needs. 2, additional resources. Be sure to download the course templates, checklists, and guides included in this course. These tools are designed to help you stay organized and prepared. Take advantage of the Q&A feature in this course to ask me any lingering questions that you might have. Number 3, what's next? If you're ready, take the first step to getting pre-approved with a lender or creating a plan to improve your financial profile. Every small action brings you closer to your dream home and to financial security and financial stability, if that is your goal in the long term. And obviously, you can contact me if you would like to get pre-approved, okay? I'm here to help. Finally, I'd love to hear from you. Share your feedback on this course and let me know how it's helped you. And don't forget to leave a review. It helps other students find this course and start their journey too. Thank you for trusting me to guide you through this mortgage process. Remember, knowledge is power, and you're now equipped to make confident decisions that will shape your financial future. Best of luck, and here's to you success as a homeowner. Now, this is an action step, which means you have to take action. I want to make sure that you're fully equipped as you move forward. Here's what's included, and I want you to download these and take these steps. Number 1, the downloadable resources. Download these templates, checklists, and guides to help you stay organized every step of the way. And I actually want you to look at them and complete them when you need them. This is very important. This will save you time, this will save you money, and it'll save you problems later on. Number 2, Q&A with the instructor. Got questions? I'm here to help. Use the Q&A section of this course to reach out, and I'll personally address your concerns. Don't forget to save these resources. They'll come in handy throughout your home buying journey. So what's your next step? Here are some suggestions. Number 1, take action. If you're ready, start by getting pre-approved with a lender. Even if you're not planning to buy right now, this will give you a clear picture of your options and what your financial situation is and how much you can afford. Number 2, create a plan. Use the tools and templates provided to map out your home buying journey, whether it's saving for a home down payment, improving your credit, or shopping for lenders. Number 3, continue learning. Stay informed by continually learning and keeping up with mortgage trends and market conditions. The more you know, the better prepared you'll be. If you found this course helpful, I'd like to invite you to check out some of my other courses. Whether you're interested in topics like advanced mortgage strategies, real estate investing, or financial literacy, there's plenty more to learn. My goal is to help you to continue to grow and achieve your goals.
Now, if you're thinking about applying, click the link below for a free consultation and let's get you pre-approved today. I'll help you out step by step and I'll guide you through what you need to do.